The Federal Reserve has been raising interest rates at a speed and a clip that most investors, including myself, quite frankly, have never seen before. But JP Morgan stock, which you would expect would benefit from higher interest rates as they loan lots of money out and earn money on higher rates, well, this stock is down 31% over the last year, and year to date down over 34%. And after reporting Q2 earnings before the bell today, the stock's down another 4.5%. What the heck is going on with JP Morgan stock? We'll dissect that and more on today's video. What is going on, investors? Hopefully you guys are doing well out there. That's right, earnings season is here, and we're kicking it off with JP Morgan, one of the first financial stocks to report. Now, they came out with their Q2 earnings. We had revenues of $30.7 billion. That was up just fractionally year over year, and it missed expectations by over $1 billion. And obviously the stock is reacting negatively to that news. Now, we'll come over here and look at this from a technical perspective as well. As you have this stock down 30% year to date, has it pulled back into an area where we'd want to buy JP Morgan? We'll talk about that broadly on today's show. Now, we'll also jump into these financials, take a look at some comments by Jamie Dimon. We'll take a look at the different business segments that JPM focus on. Look, this is a consumer bank. It also focuses a lot on businesses and corporates. We'll look at both of those and see how those are performing over at JPM. Now, this is all on the backdrop of a couple of weeks ago. The Federal Reserve, since the great financial crisis, has been doing these, quote, stress tests on banks. I think they do them every quarter, maybe every 6 months or so. And a couple of weeks ago, Bank of America in particular, Citigroup, and JP Morgan actually screened rather poorly in those Fed tests. And by screening poorly, doesn't mean they're on the verge of insolvency. Just means that these banks, especially with their exposure to the consumer and the corporate side, especially when you're looking at a JP Morgan, well, if you have asset prices like real estate and certainly stock prices and the value of businesses just continue to get depressed as we head into likely a recession here in the United States and globally, well, those companies in particular would be very exposed to that and likely many losses associated with that. So these companies, as associated with their Q2 earnings, well, JP Morgan had to suspend their buyback. We saw a couple of weeks ago, Wells Fargo raised their dividend, I think by 25%. We saw Morgan Stanley or Goldman Sachs do a similar type of raise. Well, JPM kind of pumped the brakes. I don't think they even raised their dividend, and Bank of America only rose theirs by about 5%. So we're seeing these mega corporate banks struggling just a bit in this environment. The fact that you have rising interest rates, but consumer and business banks like JP Morgan kind of taking it on the head, at least in the shorter term. That's something we'll talk about on today's show. Now, first thing that I want to start off with, we're going to run through all the financials. We'll look at the tangible book value over at JPM. We'll talk about the valuation here in a moment. But the first thing that I want to talk about is some of Jamie Dimon's comments here in the press release. And I think it sums up very perfectly not only where JPM is, but the stock market and the economy and investors kind of feeling their sentiment as a whole. Jamie Dimon says, in our global economy, we are dealing with two conflicting factories operating on different timetables. The United States economy continues to grow, both in the job market and consumer spending, and their ability to spend actually remains healthy. And I think we can see this anecdotally. You can go out and you can see some people, certainly affluent people, spending relatively like they did maybe a year or two ago. But we have geopolitical tensions, high inflation, waning consumer confidence, and uncertainty on how high rates have to go before we see quantitative tightening and their effects on global liquidity. Jamie Dimon goes on to say, we are prepared, referring to JP Morgan, for whatever happens and will continue to serve our clients even in the toughest of times. He's basically saying, look, some things are going well in the economy and some things might go extremely bad here in the future. And it's one of the reasons why JPM doesn't have maybe the flexibility of other financial institutions that we're seeing and when it comes to those dividends and buybacks. Now, first thing that we'll talk about is kind of a valuation perspective over at JP Morgan. They give you their book value per share right here at $86.38, their tangible book value, which is really if the company had to liquidate, if JP Morgan says, oh, we're going to go out of business and we're going to sell our business right now, the book value of the business, not including the brand of JP Morgan and the value of those customer relationships. Just the value of the business is about $70. Most people with a bank of this kind will probably look closer to this book value of $86 per share. I'll remind you right now, despite the 30% decline in JP Morgan stock over the last year, the stock is still trading at $107 per share, still a really large premium, in my opinion, to that book value and that tangible book. Here it is in graphical formation. We've got an over 20-year chart on a price to tangible book. Again, tangible book is if you were to liquidate JPM's assets, that's what you would get from a book value perspective. Look, it's trading at about 1.6 times tangible book. Again, despite being down 33% year to date, the price to tangible book we've seen lower over at JPM. Rarely does JPM get down to like that 1 times, and certainly like a fraction or under 1 times book value on that tangible side. It rarely happens. And in fact, if you wait for it, you're probably going to become an old man before you get to that time. But still, trading currently today at over 1.5 times tangible book, still not wildly undervalued. And I think as I go through these results, you'll see some of the reasons why. Now, we've got corporate-wide JP Morgan. We had that $31 billion worth of revenue, or in this case, they get to report about 30.7. We see this non-interest expense that rose 6% year over year. So your earnings year over year, your revenue grew about 1% from 30.5 up to this 30.7, but our expenses grew 6%. What's also growing is the fact that they didn't do very well in that stress test. So Jamie Dimon says we better set aside some billions of dollars over the next couple of quarters just in case things take a turn for the worse. So they have this provision for credit losses. Now, if you recall, back in the start of the pandemic, so we're going Q1, Q2 of 2020, we're going a ways back, banks like JP Morgan started to set aside billions and billions of dollars, not realizing the federal government was not going to require you to pay rent, pay your utility bills. They were going to shower you with stimulus checks and businesses with PPP loans that were largely forgiven. Well, all of a sudden, JP Morgan said, well, we set aside all this money thinking people were going to default on their home loans, their credit cards, their auto loans. Well, that didn't end up happening, okay, because everybody got a bunch of free money. And so they started releasing that a couple quarters later, a year later. You started seeing that money flow back onto JP Morgan's. They basically put that in a rainy day fund, and they realized it wasn't raining, the sun was shining. So they get to recognize $2.2 billion of that in Q2 of last year. Well, look what's happened over the last 2 quarters. They set aside about $1.5 billion last quarter, another $1.1 billion. Again, this is called provision for credit losses. Think of it, this is kind of like a rainy day fund. So you can imagine when your revenue goes up just fractionally year over year and your expenses go up exponentially more than that, and then you go from pulling money out of your rainy day fund to putting it back in, well, your net income over at JP Morgan is going to get obliterated. Last year, on a quarterly basis, you earned nearly $12 billion, or in this case, $11.95 billion worth of net income, and that shriveled up in the most recent quarter to $8.6 billion. Now, year over year, pretty bad, okay? That's a 28% decline on that net income. Quarter over quarter, though, it has improved just marginally from 8.2 up to this 8.6. So we'll see what happens with those trends. Now, I want to go to consumer and community banking. This gives us a great window into the consumer, especially when it comes to things like home lending and also automobile loans. Obviously, I don't need to tell you, interest rates are soaring. Home lending has been impacted very negatively by that. Obviously, when you have interest rates on a home loan go from 3 to 6 in like 6 months, that's going to impact people's ability to qualify for those loans and their willingness to take on that type of debt. And we're seeing that demand start to shrivel up. Look at home lending year over year, went down 26%. They were at 1.3 down to 1. Even quarter over quarter, we're seeing that down 14%. Last quarter, they had $1.17 billion in home lending, again, down to about $1 billion. And on the card side, that's your credit cards and your automobile loans, you're seeing a similar type story year over year, down 6% on those car loans, quarter over quarter, basically flat. Similar type of story from the corporate wide side, but on this consumer and community banking, your revenue actually went down year over year. You went from 12.7 down to this 12.6. That's a 1% decline. But look at your non-interest expense. That actually went up 9% from 7 billion up to 7.7 billion. Folks, when your revenue doesn't grow and your expenses do, well, that's going to obliterate your profits. And not only that, we talked about those provisions for credit losses from the corporate side. From the community side, last year they pulled out of their rainy day fund about 1.9 billion. This year they set aside $761 million. Last quarter they were at 678. So they've actually accelerated a little bit on those provisions for those credit losses. So they're putting a little bit more money in that piggy bank. You see here on the net income side, year over year, down 45% from $5.6 billion in net income all the way down to 3.1. That is up marginally, though, quarter over quarter. So we're seeing maybe some stabilization quarter over quarter in terms of that revenue, in terms of these expenses. But year over year, it looks really, really bad, especially when you factor in the provision for credit losses. Now, we've got our corporate and investment banks. You'd also expect a similar type of thing here. When you have interest rates starting to rise, that affects corporates' ability to borrow more and more money. We also saw kind of a phenomenon during the pandemic. Right when the pandemic started, guess what all the corporate banks or all the corporate stocks started to do? Well, they drew on their credit lines. Nike, Apple, Microsoft. All these companies pulled forward all their available credit and put it onto their balance sheet because they weren't sure what was going to happen either. And so we saw an acceleration of corporate and investment bank activity. You see evidence of it here. Look, you had 13.2 billion. This was in Q2 of 2021. You're down 10% year over year from 13.2 down to closer to 12. Even quarter over quarter, you're down significantly, down 12%, down from 13.5, again, closer to $12 billion on that. Now, what's also rising, unfortunately, is your non-interest expense here. That's up 3%. So when your revenues drop 10% year over year, your net income on the corporate side is going to shrivel up as well. Went from $5 billion all the way down to $3.7 billion. Folks, this is why this stock is down. Now we've got commercial banking here. Slightly better trend here, likely because those commercial banking clients, they aren't like the corporate side. They didn't have a line of credit for $40 billion that they could have, draw on 100%. Yeah, they may have gotten PPP loans and things like that, but they're not nearly as financially secure as kind of those corporates are. And so you're actually seeing net revenues kind of rise over here. You're seeing non-interest expense continue to go up, provisions for credit losses accelerating, net income declining from 1.4 down to 994. Asset and wealth management, just kind of your bread and butter business over at JPM, just constantly spits out about $1 billion of net income off about $4 billion worth of revenue, all things being considered, about what you'd expect over at JP Morgan. Now, from a technical perspective, we keep reminding ourselves, stock's down 30%, but from a price to tangible book valuation, still not rock bottom. Quite frankly, this one needs to get down to about 1 times tangible book. Maybe give JP Morgan a little bit of leeway, 1.2 times tangible book. We're not there yet. And look what I've got over here at JP Morgan. I've got a monthly price chart of JP Morgan. We go back all the way till most of you guys were born, all the way back to 1976. This stock, in my opinion, has been locked in this uptrend. Now, you could draw this line in a number of different ways, but what I like to do when I draw these longer term uptrends is I try to capture the vast majority. I would say 90% of the candles on one side or the other. And we do see, look, in the early 90s, this stock took a massive dump. Okay. We had the .com crisis pull us back to our trend line. The great financial crisis, you'd expect to pierce through kind of a longer term uptrend. Well, look where we are, folks. We're still well above, in my opinion, this longer term uptrend, which again, we are on a monthly chart here. We're still well above that with JPM. Would you have bought JPM back here in 2000, well above this trend line? Again, back here right before the great financial crisis, well above the trend line, and it pulled back. We're still actually, quite frankly, well above that from a technical perspective over at JPM. Now, should you wait for JPM to pull back to this trend line on a monthly chart? I would say no, because look, over the last 40 years, you've had just a couple of months. Again, each one of these bars represents a month. You've had just a handful of months, maybe a year's time at most, to accumulate this stock when it's pulled back to this trend line. So I'm not saying let's wait until let's wait till the perfect time to get JPM, because quite frankly, that might come a year or two from now, and it's basically like buying the stock today. But I still think this stock is still, at the very best, relatively fairly valued at the current time. If not, maybe still, quite frankly, a little overvalued. Now, from a shorter term time perspective, again, that's on a very like a 30-year kind of time horizon, there should be some support for JPM stock right here. We see over the last many years, I mean, this little price action up here, this is like 5 years of price action. Again, we're on a monthly chart with JPM. Each one of these candles is a month. This is nearly 5 years of price action. There should be some demand for JPM stock right here at about $107, $108 per share. Wouldn't surprise me, quite frankly, though, if we come down here to kind of this lower end of the consolidation. Over the last 5 years, the stock is basically consolidated in this area. There's a little bit of area over here, over and above, where most stocks got maybe completely overvalued. JPM more comfortably kind of in that 83 to call it about 120, 125 in that price action. Quite frankly, underneath $100 on JPM wouldn't be something I would discourage any investor do. Now, finally, if you want exposure to JPM, but you don't really want to kind of try to get in here and pick a certain price, you can invest in the XLF ETF. This is probably the most liquid and the largest ETF when it comes to the financials. I will suggest that I think a lot of investors that are watching videos like this and educating yourself, I think you can come in here and pick winners and losers, because when you look at the XLF, it's basically 15% Berkshire Hathaway, another 10% JP Morgan, another 6.5% of Bank of America, and another 4% of Wells Fargo. That's well north of 35, close to 40% of the fund is in 4 stocks: Berkshire Hathaway, JP Morgan, Bank of America, Wells Fargo. I actually think it's a good idea to pick these stocks as they continue to pull back. And I think JP Morgan falls into that category, as I would anticipate this stock continuing to move back. A lot of the things that I talked about that were from a negative perspective, the growing non-interest expense, the growing provision of credit losses, well, look, these things will turn around likely in a year or two. Expenses will start to flatten out. These credit losses, look, they're either going to have to realize them or they're going to be able to release them back into the net income. That will affect profitability in a positive way over at JP Morgan. And so I think some of these headwinds that JP Morgan are facing today will turn into tailwinds into the future. And if you are the belief that the Federal Reserve will have to continue to raise interest rates, not only keep raising them, but keep them high, quote unquote high, for a long period of time, several years, in fact, well, that will absolutely be a tailwind at some point for JP Morgan. It's just not materializing right this second, as this stock is down over 4% after reporting their Q2 earnings. That was our video today on JP Morgan. Lots more into the future. Hit that subscribe button. Love to see you in the comment section of my future videos. Hopefully you guys enjoy the day. We'll be back again soon with more. Good luck with your investments.